Professor Dr. John Silvia. I had to give that title like that. Welcome to our studios.
Thank you.
Let's look at today, shall we?
Sure.
Stocks rise for third day as China cuts rates and the Spanish bonds rally. What's going on today? Let's start with today. Can I take your opinion about it?
Well, today I think you're seeing the second major factor that has been changed since the employment report came out last week. And this was central bank easing.
Yes.
Central bank, China, big player in the world in terms of global liquidity, expressing their opinion, I think, that the economy, in global terms, needs a little bit of help. That easing makes a big difference.
Mm-hmm. But this is the first time since 2008, and they cut the rate 1%. Is this really going to help?
Well, I think from the Chinese point of view, they're becoming a participant in the global credit markets. I think psychologically for most investors, when they see this, they're saying, okay, China is now getting in the game. They're becoming part of the global complex of the ECB, the U.S. Federal Reserve, the Bank of England, the Bank of Japan. They're now becoming a global player. And so it's not just the rate cut itself, but the attitude that they're becoming a supplier of credit around the globe. They understand the challenges of the global economy, and they're helping out. And I think that's really positive.
Talking about positive,
yes.
Let's come back to the U.S.
Okay.
We had some positive data, not so positive, like the 69,000 addition in the non-farm payrolls. And you're one of the best forecasters, by the way. Am I right?
Yes.
In terms of unemployment rate. What was your rate, and how should we read all these mixed economic data? Are we in moderate recovery, or is it gloomy?
No. Moderate recovery, probably for the second half of this year, 1.5% to 2%.
Okay.
But the employment number was probably the bottom. And what we saw since then was the Institute for Supply Management survey for manufacturing firms held pretty steady in the mid-50s.
Yes.
The ISM, the Institute for Supply Management survey for the non-manufacturing firms, again stayed in those mid-50s. So since that employment report, we've been getting some pretty steady numbers that suggest the economy continues to move ahead. Yeah, it's a moderate pace, but it isn't quite the pace many people had hoped for. So the market has corrected. It's come back a little bit, but it's going to continue to struggle as we deal with continued moderate economic growth, not the traditional business cycle recovery.
And investors are hoping, you said. Investors were hoping also for the stimulus yesterday, and that's why we saw Dow Jones going up 3 digits yesterday. But what should we expect from Bernanke's speech today? And, of course, the million-dollar question, should we expect a QE3 coming?
Well, President Yellen last evening gave a presentation,
yes.
and she and Chairman Bernanke tend to follow the same intellectual path. And it does seem like Chairman Bernanke will let us know that the Fed remains ready to ease. I think at the June 19th and 20th meeting, the Federal Open Market Committee will tell us that they're going to continue with Operation Twist for a while. I think that'll open the door for them to do whatever they feel they need to do in order to be ready in case the July employment report is as dismal as the June report, in which case the Fed will be looking hard at the data and saying, listen, maybe the economy is losing some momentum. And it seemed from President Yellen's speech yesterday that they were ready to move in anticipation of a weaker economy, not waiting until they get confirmation of a weaker economy.
What kind of an impact would it have if QE3 happens? Of course, by the way, Williams and Locker, they say that Operation Twist may continue, whereas Bullard says, no need to. I don't know where you are, because you were also one of the consultants with Fed Cleveland and Chicago. I would love to hear your opinion about this.
Well, my sense is that you can continue Operation Twist, but you don't have to continue it as big as it was before. So it's more like an insurance policy. I can do Operation Twist and maybe only do 10 to 20 billion if the economy does show some signs of reacceleration. But if the economy continues to sort of drag here and the unemployment rate tips up again, I can get more aggressive in Operation Twist without committing to a major QE3 program at this time. So I think Chairman Bernanke can probably move the committee in the direction of saying, let's continue Operation Twist. We're not going to specify how much, but we're going to keep that door open in case this economy weakens and or something with respect to Greece, for example, on June 17th shows up, and then we have to anticipate those problems.
Greece, right? You
Yes.
just said Greece. The possibility of Greece departure. You write in your report a gloomier outlook for the global economy. Is it really gloomy? What is it? Is it the fear of Greece leaving, or is it the contagion factors? What's next?
Well, it seems that the trade impact is something you and I have talked about
Yes.
before, of Europe slowing, and particularly the challenge with Greece, has started to impact U.S. exports to Europe, Chinese exports into Europe, and as a result, you have to look, take a little bit off the top in terms of growth expectations in the global economy, and that's what we've done. So yes, it's a little bit more cautious on the global scene in terms of overall economic growth. We're not talking recession, but yes, clearly the European situation, the Greece situation, has filtered into the global economy.
Some people say that, like Warren Buffett, who was very optimistic, but nowadays he says that if Greece and also Europe goes into this crisis, it might affect the U.S. economy too, and it might even force Fed to do some stimulus. Do you agree?
I think depending upon the degree of problems in Europe, I got to believe, and maybe going back to your comments about China,
yes,
that what we're seeing is a coordination of monetary policy moves.
Yes.
And I'm sure that every day someone at the Fed talks to someone at the People's Bank of China and the Bank of England, the ECB, and the Bank of Japan. And we may see more coordination because the reality is we are dealing with countries that really impact each other. We're not dealing in isolated silos. And I think everybody kind of gets that right now. And so I think one thing we might look for in the next 2 to 3 months is more coordination among the central banks of the world.
And the last question.
Yes?
The fiscal cliff.
Yes.
What should we expect? Yesterday I was at the National Economic Council's conference, and Gene Sperling, he spoke, but are they going to extend it beyond 2012? What is your expectation?
My best guess is they're going to kick the can down the road. They're going to come to an agreement and say, listen, we're going to leave everything in place for about 6 months or so until June of 2013. That's going to give us 6 months, Congress and the President, 6 months to work out whatever they're going to do.
But will the Republicans allow that?
I think at this point in time, yes. I think they'll go along with just moving it down the road. I think we've heard a little bit from Bill Clinton, former President Bill Clinton, that we can do this, we can do that. Kind of get a sense that he's looking at some type of compromise. I think Congressman Ryan has sort of hinted that, hey, we can work this out. We just need a little more time. I think they're going to buy themselves some time.
Thank you so much. Our
Thank
time
you.
is up, but we have to have you again. You came all the way from North Carolina
Yes.
to New York, and we were very lucky, very blessed to have
Thank
you
you.
at our studios.